Hey everyone, welcome to today's deep dive. We're diving into a classic today,
A classic, yeah.
The Intelligent Investor by Benjamin Graham.
That's a good one.
It's been highly influential for decades, and we're going to be talking about a distinction that I think a lot of people get tripped up on, which is the difference between investing and speculating.
Yeah, investing versus speculating.
Are you ready to make sure you're on the right track?
Absolutely. Let's go.
Right.
It's such a crucial concept, and so many people use these terms interchangeably.
Yeah, and especially today.
Especially today, everything moves so quickly.
Fast-paced market.
Yeah, really easily to get caught up in the hype.
Right. Everyone's a financial whiz now, but Graham lays it out pretty clearly.
He does.
He says, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative.
Okay, so thorough analysis, that's key.
Right.
That often gets missed, right?
Yeah.
People just hear a hot stock tip or see something flashy online and they jump in.
Right.
But that's not investing, that's speculating.
Totally. And he actually even calls this out in his book. He's got these funny newspaper headlines from the 60s.
Oh, what are they?
Like, one says, small investors bearish. They were selling odd lots short.
Oh, wow.
And another one says, reckless investors.
Reckless investors.
So clearly the term investor was getting thrown around.
Yeah, even back then.
Even back then, pretty loosely.
Yeah, I think it highlights the point that just because you're buying or selling stock doesn't make you an investor in the true sense of the word. Like you were saying, blindly following the herd,
Yeah.
getting caught up in FOMO, fear of missing out. That's speculation.
Totally.
It's not investing.
Yeah, and he doesn't mince words about it, the dangers of mistaking one for the other.
Right.
He points out 3 big mistakes.
Okay.
1, thinking you're investing when you're actually speculating.
Mm-hmm.
2, speculating without the knowledge or skills to back it up.
Okay.
And then the third one is risking more money than you can afford to lose.
Right. Big one.
It's like playing poker with your retirement fund.
Yeah, exactly. You have to be honest with yourself about your risk tolerance, your knowledge, and what your goals are.
Yeah.
Speculation can have its place, but it shouldn't be confused with a sound investment strategy.
Totally. So how do we steer clear of those speculation traps
Right. How do we avoid that?
and actually become intelligent investors?
Yeah.
Graham outlines kind of 2 main approaches.
Yeah.
The defensive investor and then the enterprising or aggressive investor.
Got it.
So let's start with the defensive investor.
Okay.
This is someone who prioritizes safety and simplicity. This is about participating in the market's potential without losing sleep over every dip and spike.
Yeah, exactly. And Graham recognized that not everyone has the time or the interest to be like a Wall Street guru.
Right.
Like the defensive investor, they just want to grow their wealth steadily and reliably.
Totally.
Yeah.
With a healthy dose of caution.
Right.
Right. And so one of the key strategies he recommends is diversification. Diversification.
Mm-hmm. And, back in '64, when he was writing this, he suggested a portfolio split between high-grade bonds and leading common stocks,
Okay.
with a minimum of 25% and a maximum of 75% in either.
So a pretty wide range there.
Yeah, he even suggested like a simple 50-50 split.
Okay.
That's like a good starting
to
point.
get going, yeah.
Yeah.
For most people.
That balance between the bonds and stocks, that's really crucial because that's how you manage risk.
Yeah.
The bonds, they provide that stability and that fixed income. And then the stocks, they offer the potential for growth.
Right. So it's about finding that sweet spot
Yeah, finding that balance for you.
that aligns with your individual risk tolerance.
Exactly.
Here's where it gets really interesting.
Okay.
Graham actually noted that from 1964 to 1971,
Okay.
cash equivalents often outperform stocks.
Really?
Can you believe that?
Wow. So just holding cash.
Even with inflation.
Interesting.
I know, it's crazy, right?
That's wild.
That's wild.
It seems counterintuitive, but I guess it speaks to the fact that it's really hard to time the market.
Yeah,
Even experts don't always get it right.
totally. So what's a defensive investor to do?
Right.
Should we all just stuff our money under the mattress?
I mean, not exactly. Remember, diversification is key.
Right.
And bonds, they're a little bit different today than they were back then
Yeah, that's true.
because interest rates are higher now than they've been in years.
Right.
So bonds are suddenly more attractive
They are
for
attractive.
that defensive investor.
Yeah, that makes sense. Higher interest rates, better return
Exactly.
on those bonds. But so how does that impact
Yeah, that's a good question.
that classic Graham portfolio allocation, right? Like, should we be shifting more towards bonds and less towards stocks?
Well, remember, Graham's principles are timeless, but we do have to adapt to the current market.
Right.
The specifics might change.
Totally.
It's about finding that balance between risk and reward.
For sure.
But a strategy that can be really useful for defensive investors is dollar cost averaging.
Dollar cost averaging. Tell me more. Okay, so we've covered the defensive investor.
Yeah.
What about those of you who are ready to embrace a bit more risk?
Yeah, a little more risk appetite.
In pursuit of higher returns, Graham calls this the enterprising or aggressive investor.
Right. The investor who's ready to dig in a little deeper,
Yeah,
knowing that there might be some higher risks involved.
totally. And Graham outlines 3 approaches that these investors often take,
Okay. Hi.
although he is a bit skeptical about whether they can consistently outperform the market.
Yeah, he doesn't sugarcoat it.
No.
He talks about market timing, so buying low and selling high,
Right.
trying to time it perfectly, which,
Good luck.
yeah, difficult to do consistently.
Very difficult.
And then there's short-term selectivity.
Okay.
That's where you're chasing earnings reports.
Right.
You're jumping on the latest hot stock tip, just trying to ride the wave.
That's like the stock market version of FOMO, right?
Totally, yeah, exactly.
Yeah.
And then the third one, long-term selectivity.
Okay.
This is where you're like, okay, I'm going to focus on companies that have a history of growth
Right.
or ones that are maybe poised to capitalize on a trend.
Right.
Sounds good in theory,
It does.
but he uses the example of the airline industry
Okay.
and how, all of the predictions about that industry have been,
Nobody could have predicted
yeah, totally wrong.
all of the changes that's gone through.
Right, exactly. So it just goes to show that
It's impossible.
it's really hard, even with all the research in the world, to predict these massive shifts with any certainty.
Yeah, so where does that leave the aggressive investor?
Right.
Like, does he offer any guidance?
Well, he does mention special situations like
Okay.
mergers, acquisitions, arbitrage.
Yeah.
You're kind of capitalizing on market inefficiencies when those things happen.
Right.
But even he acknowledges that those are more complex than they used to be.
Yeah.
More competitive, even for a seasoned pros.
Right.
Um,
So this is where Graham throws us a little bit of a curveball.
okay.
He says, to enjoy a reasonable chance for continued better than average results, the investor must follow policies which are 1, inherently sound and promising, and 2, not popular on Wall Street.
Okay, so if it's popular,
Sounds like what?
stay away.
It seems like a contradiction.
I mean, it seems counterintuitive, but it's really the core of his philosophy.
Okay.
It's like if everyone is already doing it,
Yeah.
all the gains have probably been made.
The easy money's gone, right?
Right, exactly. So you have to look where others aren't looking
Oh, I see what he's saying.
to find those hidden gems.
Right, the undervalued company.
Exactly, with real potential.
I could see how that would lead to above average returns.
Right.
But it takes guts
It does.
to go against the grain like that.
It takes, yeah, independent thinking.
For sure.
You have to be willing to challenge the conventional wisdom. And then you have to have the discipline to stick to your guns,
Right.
even when it's not popular.
Totally. So as we're wrapping up our deep dive on the intelligent investor,
Yeah.
I think the key takeaway here is
What's the big takeaway?
understanding the difference between investing and speculating,
It's crucial.
no matter your risk appetite.
No matter your risk appetite, yeah. And it's impossible to time the market perfectly.
Yeah,
But the opportunities are out there.
they are out there.
For those who are willing to put in the work and kind of think differently,
Totally, and embrace that long-term perspective.
absolutely, that long-term perspective.
Here's a final thought to ponder.
Okay, hit me.
If the most promising investments are often the ones that are overlooked,
Mm-hmm.
undervalued,
Yeah.
how can you apply that same principle to other areas of your life?
Ooh, that's a good one.
That's something to think about.
I like that.
All right, that's it for today's deep dive.
Thanks for having me.
Thanks everyone for listening.